Every morning, the stock market opens as a chaotic engine of moving parts. Thousands of equities are suddenly repriced in real time, driven by shifting attention. To manage this data overload, most automated trading systems rely on a fixed hard-coded watchlist, checking the exact same 10 or 20 familiar tickers every single day. This static approach misses sudden moves. A previously active stock might be dead today, while an obscure midcap just secured an FDA approval. The OpenSpider system avoids this bottleneck. It is an algorithmic trading pipeline engineered with zero hard-coded tickers. Instead of asking if it should buy a specific stock, the architecture queries the entire market every single run to ask, what is moving right now? To find the answer, it uses a 5-phase pipeline that filters thousands of equities down to one optimal setup. Alpha in automated trading requires an architecture that dynamically adapts to where the market's attention is focused today. Phase 1 begins with dynamic discovery. The system hits 3 separate real-time screener endpoints via the Alpaca API to pull down whatever the market is actively buying and selling. These 3 lists are immediately combined and deduplicated, prioritizing assets with the highest volume. Filtration removes warrants, special instruments, and tickers longer than 5 characters. The system then drops the floor. Any stock trading under $3 is automatically discarded to keep highly volatile penny stocks out of the portfolio. What remains is a clean, highly active candidate pool of exactly 30 to 45 unique symbols. This aggressive initial culling ensures the system only spends computational power on assets the broader market actually cares about, rather than wasting resources analyzing dead charts. In Phase 2, the system shifts to deep technical analysis, fetching the last 200 days of price history for every surviving candidate. It calculates moving averages across those price bars to identify trends, and momentum oscillators like the relative strength index to identify overbought conditions. It also measures relative strength, calculating each candidate's 63-day return, specifically against the S&P 500, to identify true market leaders. The critical SPY regime filter plots the S&P 500 against its 200-day average. When price crosses above this line, the market is bullish, and the pipeline remains open. If price drops below the average, the regime turns bearish, and the pipeline immediately halts. Historical backtesting proves that trend-following strategies aggressively bleed capital during choppy markets. When the regime filter turns negative, the OpenSpider system sidelines itself and refuses to trade. During these negative regimes, the probability of a trend-following setup succeeding drops significantly. Individual technical signals often fail when they are fighting the broader market's downward momentum. Candidates that survive the macro filter enter Phase 3, the ranking process. The system now sorts the remaining 25 to 35 equities by statistical probability. It assigns a composite swing score to each asset, graded to 100, based on 5 data streams. Trend and momentum indicators reward healthy uptrends. Then, relative strength, institutional volume, and sector momentum streams activate, locking the final score at 85. Only candidates that generate a combined score of 80 or above are considered viable for a swing trade. This multi-dimensional scoring matrix translates complex chart patterns and sector rotations into a cold, deterministic integer that the script can perfectly sort. In Phase 4, the system takes the top-ranked candidates and hands them off to a large language model for qualitative analysis. The script constructs a JSON payload with ranked candidates, account cache, and the VIX index. It injects recent news headlines directly into the block. If keywords like EPS are detected, the ticker flashes an earn tag, blocking the AI to protect against earnings risk. The system gives the AI a strict prompt: review the context, articulate a thesis, and pick the single best swing trade. If nothing looks optimal, it must return a definitive skip command. The model processes all these variables and returns a structured output, isolating just one ticker for potential execution. Large language models are powerful reasoning engines, but in quantitative finance, their utility is only unlocked when they are strictly confined within a mathematically curated data sandbox. Even within an AI's endorsement, execution is not guaranteed. Phase 5 requires the selected trade to survive the gate chain. This is a 12-step gauntlet built on a default deny principle. If the trade fails at any single checkpoint, the script aborts the entire run. The initial guardrails are rigid. The AI's confidence score must sit above 60%. The asset cannot be a leveraged ETF, and the exact order parameters must successfully clear a simulated paper trading drive run. The master safety mechanism is Gate 3, the edge gate. It queries historical logs to verify a mathematically positive expectancy. The strategy must be profitable across 3 distinct market windows. Passing these checks provides the final authorization. This final gate is the system's absolute defense, answering the most vital question in quant trading. Does this strategy actually make money, or are we just gambling? From the initial dynamic API scrape to the deep quantitative screening, the LLM synthesis, and the edge gate validation, the architecture forces every potential setup through an extreme filter. It takes a chaotic universe of over 8,000 active equities and programmatically compresses them to a single, highly scrutinized execution. Because of this intentional friction, the vast majority of the system's daily runs end without a single trade being placed. This behavior represents the foundational design of a system built primarily for capital preservation. In algorithmic trading, a system's true edge is found in its aggressive, programmatic capacity to say no.